Today, we're looking at what's been going on in China as the CCP's financial team is effectively buying Chinese stocks to support the market. And then the trading takeout today is why you should never buy trading signals from anybody online. But first, make sure you like and subscribe to the channel so that I can pop up in your YouTube feed every single day to improve your trading edge. So news in China is that the Shanghai Composite fell to fresh multi-year lows under 2,700, with some highlighting increased capital flows from Hong Kong via Stock Connect, which is basically like their equities system. Effectively, what's happening now is there's been a relatively large bounce, which I'll show you just here. But the reason for this bounce is probably the most interesting component. And the reasoning is that the Chinese government is effectively supporting the market. So buyers stepped in here, some pretty random buyers, if you like, i.e., yes, the Chinese government. They stepped in there and bid the market back up. But what you'll notice is that at close, we started ticking back down again already. So there's something interesting here that we can sort of highlight. And it is that unless you've got a reason for the risk-free rate of return to change, which effectively changes the opportunity cost of buying certain assets versus other ones, just because you're a government and you're printing money and you're going out to buy stocks doesn't mean that anyone's going to be interested. In fact, I mentioned yesterday on TikTok, actually, I've run a TikTok account, and I'd mentioned that Gordon Brown sold the low in gold in the early 2000s. Okay, Gordon Brown, if you're not from the UK, was a UK chancellor, and he basically controlled the UK finances, and he sold a lot of the UK's gold at about, I think it was like $600 to $700 per ounce. It could be different to that, but roughly at the low. And then it went on to obviously rally all the way up to $2,000 where we are today. So there was a big loss for the UK there. And it's the fact of the matter is that the public sector, no matter where you are, there's no risk because you are the government, you are the market, effectively. So you've got people out there who don't necessarily understand that conducting an activity doesn't matter because there's no profit maximization incentive, or there's no profit motive, basically. And so based off of that, you've got the government buying Chinese equities, but it doesn't necessarily matter because the market is going to say, well, there's no real competition there. I don't really care. What they're going to think of is when this ends, the market's going to come and continue on its way down. So there's no real momentum driver, and that's why we're seeing it sell off right there. The government tends to be, when you get into markets, the government tends to be the greater fool at the end of the day whenever they try and do this stuff. You see it consistently. You see it with the housing market. You see it with loads of stuff. You know, they tend to end up holding the bag. And so I think in this case, what we are looking at is the government, the Chinese government, effectively fighting the market here. I think we head back down to those lows, which we can have another look at. I think we head back down here and test it again, because I've got a saying, and it is, if it prints there once, it will print there again. It happens consistently in markets. Like, it's one of my favorite sayings because you can literally revisit it all the time. Like, even here, look, okay, a couple of years ago, prints there once, it will print there again. There's another low here, prints there once, it will print there again. A great example of this actually is with the New York Community Bank that's recently gone a bit poorly, let's say. Last year, you know, during all the bank crisis with Silicon Valley Bank, prints there once, prints there again. So that's a fantastic phrase to look at and to understand, okay, what is going on, especially on the downside, especially on downside moves. I'm not saying it happens consistently, but with certain volatile stocks that are outside of the top 5 to 10, it happens. It happens, certainly. So fantastic quote to sort of live by there. But yeah, with China, I think what we're currently looking at is think that's the ticker. I think what we are currently looking at is absolutely, some considerable issues there with regards to the equity market, with regards to risk, and how the Chinese economy is trying to change to a domestic consumption-led economy rather than an export-driven economy. Not quite achieving that just yet, as we can see through its equity markets and also its general economic data. But we're going to see how this develops over the weekend as well, because I'm certain the Chinese government probably does stuff over the weekends. It is very, very different to ours, and that's something we've always got to bear in mind. Don't always look at what China does through a Western lens, look at it through a Chinese lens. Very important information there. Don't buy trading signals until you have watched this video. Now, I'm sure you have seen trading signals in FX, maybe even stocks or whatever else, advertised all over the internet, whether it's Instagram, Twitter, maybe even here on YouTube. But there's a big reason as to why you should never invest in them. And it's purely because these trading signals, if they are systematic, for example, would mean that you had to trade every single one of them. And that is even considering the fact that it might even be profitable, let alone most likely not profitable of a strategy. Now, the reason for this is that if it is a profitable strategy, you're going to test it over, say, 100 trades or maybe even 1,000 trades to get a strong enough sample size to understand what your edge is. But if you're only trading, say, 50 of those 100 trades, you've not completed the entire population size of the trades for that strategy. So you might have the first 50 trades which don't make any money, but then the back 50 do actually make the money. So you have to trade a complete size of a strategy's population to be able to deduce whether you're going to make money at the end of it. The other fact is that most of these guys just aren't even profitable anyway. And what they want you to do is churn some volume so that they get an affiliate payment. And it's a very lucrative business at the end of the day, but it does get people caught up. So never invest in trading signals, but do invest in good quality education. Look at reviews, look at what other people are saying. And don't get sucked in by any sort of marketing jargon behind any special strategies or anything like that. There is nothing special about any of these strategies. Most of the edge comes from good risk management and good trade management. And that is a complete fact.